first up, because if you look at the loan growth for FY25, it was around 14 to 15%. Your endeavor is to grow higher than the system run rate. So according to you, given the overall scenario that we are in right now, what do you think the system run rate could be, and what will the growth rate be for your bank, that's City Union Bank? Fair to assume that you will sustain the momentum, hopefully above 15%?
Yeah, hopefully for the financial year 25-26, based on the factors which are visible at this point of time, we hope for next year also the systemic growth rate will be about 12 to 13%, and we should also be having in a position to maintain the current growth rate of about 14 plus or minus 150 basis point. This 14% growth we could achieve after paying back some of the low yielding assets in the like say getting back like say the closing the advances of the low yielding NBFC funding and also some IBPC purchases, the interbank like say participation certificate purchases. So with that, we should be in a position to maintain our current momentum of about 2% over and above the growth rate of the industry, what we had envisaged earlier. I think we are on track. Hopefully, we hope the like say the geopolitical things and all will not get any deteriorated from whatever we were. Be it on asset quality front, like say stress assets front, on growth front, everything looks like we should be in a position to go with the growth rate of about 2 to 3% over and above the growth rate of the system is what we envisage at this point of time.
So let's talk about NIMs, because you've also mentioned that you were expecting to maintain the NIMs at around 3.5 to 3.7% levels. But you have rate cuts that are actually impacting some banks in terms of their outlook for NIMs. So what gives you the confidence that you'll be able to maintain your NIMs at the current level or at the level that you mentioned, about 3.5 to 3.7%?
See, as you rightly said, whenever you are entering the increasing interest rate cycle, your margins get slightly expanded as your assets get repriced quickly. And when you get into like say decreasing interest rate scenario, obviously the margins show like say propensity to get reduced. Fortunately, in this cycle, when we enter, we were able to take some steps to maintain our NIMs. One important factor which depends upon this particular phenomenon is how fast the rate of interest in the decreasing interest rate scenario declines. If this, like say, expected NIM contraction of about 50 to 75 basis point happens over the period of next 3 to 4 quarters in a slow and steady pace, the whatever benefit we get in the repricing of the deposits, like say, will be sufficient to take care of the like say decreasing interest rate scenario in terms of from the asset side. So hopefully by and large, we expect that the rate of interest reduction in this cycle will be at a phased and steady manner. It will not be like we will have, like say, very, like say, high interest rate reduction happening at a shorter span of time, flooded with liquidity in the system, reducing the rate to decrease much faster and all. We expect if this is, like say, slow and steady pace, as we have seen in the past, like having about 50 to 75 basis point happening over the period of next 3 to 4 quarters in a slow and steady fashion, we should be in a position to maintain our net interest margin. And as we have said in our con call, 90% of last 50-60 quarters, we were able to maintain in a range of 3.4 to 3.7, and whatever we have showed now comes in that gap. And we feel, I mean, the factor which determines that will be like how quicker your rate of interest reduction cycle happens. At the current expected level, we hope we should be in a position to, by and large, maintain in this smaller range.
Right. Let's talk about your deposit growth, because you've delivered a very healthy number on that particular front as well. But your CASA is currently at around 28.5%, which is a tad bit lower than the 30% range that we've actually seen for the bank. Going ahead, what's your outlook on that particular front? Will CASA drive majority of the growth? What's your strategy?
So as we have explained in the earlier thing, our bulk of our liability side is supported by the retail term deposits. So going forward, our endeavor is to get that 30% CASA ratio as quick as possible, and we have started taking efforts on that. So we had a couple of years when we had a single-digit growth rate, and at that point of time, we had to accelerate the growth engine on the asset side, which we have stabilized. And now our endeavor is to balance the liability side, particularly CASA, to support the growth rate of liabilities with required CASA percentage, so that our liability side cost is also maintained. So our endeavor is to get back that 30% as quick as possible.
Right. Let's talk about the unsecured side of your book, which is small, which is very small, with personal loan portfolio at just about 2% or so. We saw many banks that are actually struggling due to this over leveraging in the personal loan segment. Do you think that the asset quality concerns now we can say are behind us, and what will be the growth rate for your bank when you talk about the unsecured segment? Are you going to be pretty conservative and maintain it at those levels?
Yeah, as we have explained in the earlier discussions with you people, our focus had always been on the as much as possible regulatory retail portfolio, but on a secured front. So MSME, commercial trading, agriculture, gold loan and all constitute about 80 to 85% of our loan book, and that composition by and large will stay. And we are, slowly increasing the retail advances side, be it on the, now only we have recently entered in a small way in a credit card and also in a personal segment, because the liability customers now need that products which we did not have earlier. Particularly after the arrival of our digital lending platform and technology in hand, we would like to particularly take care of our existing to the bank customers on the retail front. But unsecured will be mainly on our existing customer, and it will be a very small portion, as we have maintained maybe about incrementally about 1 to 2% is what we anticipate. So that has not become a matter of concern to us, as we have not been very aggressive on that particular segment of unsecured retail credit, and we are not envisaging that in the near future. We will continue with our conservative lending philosophy with more focus on the secured both MSME, commercial trading, gold loan and agriculture and all. With a little focus on the retail unsecured front, which will be an added product for focusing on our existing to the bank customers.
All right, point taken there. And we will wish you all the very best, sir, for the future quarters going ahead, especially for the financial year FY26. Thank you so much for being part of the show and talking about City Union Bank. That was the management of City Union Bank talking about their earnings. But on that note, we slip into a break on this edition of First Take.
When the stakes are high and the answers are elusive, there's one voice on a